You wanted a silent night. You wanted to sip your eggnog and pretend the economy is not burning down around you. Well, I have bad news. The market does not care about your holiday plans. While the Western world is comatose, something dangerous is happening in the East. Look at your screen. It says silver is $72. Now, take that screen and throw it out the window because it is lying to you. The real price, the price people are actually paying with blood and sweat in Shanghai right now, is $78.49. That is a $6.49 gap. In the financial world, that is not a gap. That is the Grand Canyon. It is a glitch in the matrix that is not supposed to exist. Think about it. If you saw an iPhone selling for $1,000 in New York and $5,000 in Shanghai, what would you do? You would buy every phone in New York and ship it to China. That is called arbitrage. It is free money. It is the easiest game in town. So why is nobody doing it? Why is the gap not closing? Because the iPhone in New York is fake. It is a drawing of a phone. It is a paper promise. But the one in Shanghai, that is the real metal. That is what we are seeing today. A complete separation of reality from fantasy. While you are staring at charts and moving averages, the physical market in China just screened 8.12% higher in a single session. Let that number sink in. 8% in one day. Commodities do not move like that unless there is a war, or unless someone just realized the vaults are empty. This is not a rally, this is not volatility, this is a crime scene, and you are the victim who does not know he has been robbed yet. We are seeing premiums explode to $7 and $8 per ounce. That is the market telling you that the spot price is irrelevant. It is a fictional number kept alive to make you feel safe. But safety is over. In the next 20 minutes, I am going to show you why your wallet is about to get shredded by a mechanism you did not even know existed. We call it the arbitrage gap. But you can call it the end of the world as you know it. Markets do not close gaps like this politely. They close them violently. And if you think this is just some boring story about metal prices, you are wrong. This is the story of the moment the paper money system broke. Welcome to the panic. Let us look at the evidence. We are walking through a crime scene here, and the fingerprints are everywhere. First, look at that move. 8.12% in a single session. Do you understand how insane that is? Major global commodities do not move 8% in a day unless a nuclear reactor just melted down. Bitcoin moves 8% when Elon Musk tweets a meme. Penny stocks move 8% when the CEO gets arrested. But silver is supposed to be the boring old man of the market. When the old man starts sprinting at 40 miles per hour, you know the house is on fire. This is not speculation. Speculators buy paper contracts and hope to sell them before lunch. This is desperation. This is industrial panic. This is a factory manager realizing that if he does not get metal today, his assembly line stops tomorrow. And then look at the premiums. We are seeing premiums of $7 to $8 per ounce. Let me translate that for you. In a normal, civilized market, the premium is like a tip for the waiter. It is 50 cents, maybe $1. It is polite. But a $7 premium? That is not a tip, that is a bribe. That is the cost of bribing the bouncer to let you onto the last lifeboat to the Titanic. It means the spot price on your television screen is absolute garbage. It is a discount coupon that expired 20 years ago. The real price is the spot price plus the bribe. And right now, the bribe is getting expensive. But here is the smoking gun. The body in the library. 17.7 metric tons of silver were removed from the Shanghai vaults in 24 hours. Poof. Gone, vanished. Let me visualize that for you. That is 569,000 ounces of physical metal. That is not a rounding error. That is a fleet of armored trucks driving out of the exchange, loaded to the suspension limits. Where did it go? It did not evaporate. Silver does not have a half-life. It went into private storage. It went into deep, dark holes where paper traders cannot touch it. Someone out there knows something you do not. They are trading their fiat currency for heavy industrial blocks of reality. They are not waiting for a dip. They are not looking at the relative strength index. They are draining the vault. This is a bank run, folks. The only difference is, instead of lining up for dirty paper cash, they are lining up for the only thing that actually matters when the lights go out. And right now, the teller window is slamming shut. Now, let me put on my professor hat for a second. I am going to teach you Economics 101. But do not fall asleep, because this lesson might save your life. In a functioning universe, we have a thing called arbitrage. It is the closest thing to a free lunch you will ever find. Here is how it works. You see silver trading for $72 in New York. You see it trading for $78.49 in Shanghai. What do? You buy the cheap stuff in New York, you put it on a boat, you sell it in Shanghai, and you pocket the difference. Easy, risk-free. A $6 profit per ounce for doing absolutely nothing but moving a box. In a normal market, thousands of greedy traders would jump on this trade instantly. They would buy New York until the price went up, and they would sell Shanghai until the price went down. The gap would close in 5 minutes. That is how markets self-correct. That is the invisible hand of capitalism. But look around you. The hand is broken. The gap is not closing. It is getting wider. Why? Because you cannot put a paper contract on a boat. You cannot ship a digital promise to a solar panel factory in China. To execute the arbitrage, you need the physical metal. You need a 1,000-ounce bar that actually exists. And that is the problem. The cupboards in the West are bare. The vaults in London and New York are full of IOUs and rehypothecated fantasies, but they are running out of the heavy yellow and grey stuff. This is the nightmare scenario. The bridge between West and East has collapsed. Not metaphorically, mechanically. The metal is not flowing fast enough. Even if you could find the silver in New York, good luck getting it to Shanghai by tomorrow morning. Logistics take weeks. The demand in Shanghai is happening right now. They do not want silver in 3 weeks. They want it before the market opens on Thursday. So we are stuck in a doom loop. Shanghai pays more. Traders try to drain the West to feed the East. The Western vaults get even emptier. The panic in the East gets worse because they see the supply drying up, so they bid the price even higher. It is a death spiral for the paper shorts. The Western traders are sitting there trying to fight a forest fire with Excel spreadsheets, while the guys in Shanghai are using actual buckets of water. And let me tell you, the fire does not care about your spreadsheet. The mechanism is broken, and when the gears stop turning, the machine explodes. You need to understand the psychology of the buyer right now. We are not talking about some kid day trading from his basement in his underwear, looking at a relative strength index on a chart. Speculators are weak. If the price gets too high, they walk away. They go buy Bitcoin or Tesla options. They have no loyalty. But the people driving this move in Shanghai, they are not speculators. They are hostages. Imagine you are the manager of a massive solar panel factory. You have a contract to deliver 10,000 panels next month. That contract is worth $5 million in revenue. If you deliver, you get paid. If you fail, you lose the contract, your reputation gets torched, and your company goes bankrupt. Now, here is the catch. You need silver paste to make those panels work. Yesterday, silver was $72. Today, it is $78.49. That jump costs you an extra $42,000. It sounds like a lot of money, right? Wrong. It is peanuts. It is a rounding error. Here is the choice you have to make. Do you refuse to pay the higher price, save the $42,000, and lose the $5 million contract? Do you tell your client, sorry, I cannot build your energy grid because I was waiting for a pullback on the daily chart? No, you do not. You shut up, you pay the $78, and you thank God you got the metal at all. This is called inelastic demand. It is a fancy economic term that essentially means, I have a gun to your head. The price of the silver does not matter anymore. The only thing that matters is availability. The factory manager does not care about moving averages or resistance levels. He cares about whether his assembly line stops tomorrow morning. And this is why the price is not going to gently drift higher. It is going to jump. Because it is not just one factory manager, it is thousands of them. And they are all looking at the same empty vault. Factory A bids 78. Factory B bids 79. Factory C screams 80. They are not negotiating price. They are bidding for survival. While the Western trader is drawing lines on a screen waiting for a correction, the industrial buyer is panic buying everything that is not nailed down. The trader thinks the price is expensive. The factory manager knows that the most expensive silver in the world is the silver you did not buy when you had the chance. This is how you get a gap that rips the face off the short sellers. The question shifts from, what is the price, to where can I find it? And once that question is asked, there is no ceiling. So here is how the movie ends. We are approaching the Endgame scenario. The timing could not be worse. We are heading into holiday trading conditions, the trading desks are empty, the senior risk managers are on a beach somewhere, and the junior interns are left guarding the button. This is what we call thin liquidity. In a crowded room, you can push someone, and the crowd absorbs the shock. In an empty room, a small push sends someone flying through the drywall. Imagine this scenario. Shanghai opens for trading while New York is asleep. The Asian buyers see the weakness. They smell the blood in the water. They push the price from 78 to 80. Then 82. There is no one there to sell to them. The price just floats up like a balloon with the string cut. Then New York wakes up. Imagine the trader spilling his coffee on his shirt at 8 in the morning. He looks at his screen. The closing price yesterday was 72. The price in Shanghai is now 82. That is a $10 gap. That is a 14% spread. Panic does not even begin to describe it. The computers start screaming. The algorithms that are programmed to arbitrage the difference try to buy, but there are no sellers. This triggers the gamma squeeze. The market makers who sold call options thinking they were selling free money suddenly realize they are on the hook for millions of ounces they do not have. They have to buy to hedge. Their buying pushes the price higher, which forces them to buy more. It is a feedback loop from hell. And when that gap hits $10, something fundamental breaks. The paper market in the West loses all credibility. It becomes a clown show. If the COMEX says silver is $72, but you cannot actually buy any silver for less than $82 anywhere on the planet, then the COMEX price is a lie. It is a museum exhibit. At that point, the big players stop using the exchange. They go to the black market. They go direct to the miners. The volume on the exchange collapses to zero, or worse, the exchange halts trading. Remember the nickel squeeze? Remember when the London Metal Exchange just turned off the machines and cancelled the trades because the price went too high? That is the endgame. When the casino realizes it cannot pay out, it does not write you a check. It unplugs the slot machine and calls security. We are not just looking at a price spike. We are looking at a system failure where the paper price becomes a ghost and the physical price becomes the only truth left standing. We are in uncharted waters now. You cannot rely on your old textbooks. So I am going to give you the survival guide. Here are the 5 signals you need to watch in the next 24 hours to know if the system is finally snapping. Signal number 1. Watch the Shanghai Open. If it holds above $78.49, the gap is confirmed. If it gaps higher, run for cover. Signal number 2. Watch the lag in New York. If the West tries to close the gap but fails, if the price here stays flat while China rips higher, that is the death of the arbitrage. That means the pipes are clogged. Signal number 3. This is the big one. Physical premiums. This is your lie detector test. If the spot price is 72, but your local dealer is asking for 88, listen to the dealer. He is the one with the metal. The screen is lying. If premiums expand, the physical market is declaring independence from the paper market. Signal number 4. Look for the out-of-stock signs. If dealers switch from buy now to call for quote, or if shipping delays jump from 3 days to 3 weeks, that is rationing. That means the inventory is gone. Signal number 5. Volatility on low volume. If you see the price jump $2 in 5 minutes on zero volume, that is a liquidity vacuum. That is the air being sucked out of the room right before the explosion. So, what do? It is simple. Stop looking at the paper price. It is a distraction. Do not be the guy holding a contract that says silver. Be the guy holding the silver. When the music stops, and it is stopping right now, do not be the one searching for a chair. The gap is $6.49 today. Tomorrow, it could be 10. By next week, the two markets might not even be speaking the same language. This is not a drill. This is a transfer of wealth from those who trust the system to those who understand reality. The Shanghai Express is leaving the station. You are either on board or you are on the tracks. If you want to survive the reset, you know what to do. Smash that like button so the algorithm warns the others. Subscribe, because the next 48 hours are going to be historical and you do not want to miss the autopsy. Good luck. You are going to need it.